This entire philosophy of patience, of waiting for the one, true, decisive moment, was chronicled with brilliant clarity by Edwin Lefèvre in his timeless work. The lessons contained within it are as relevant today as they were a century ago. A link to his essential book, Reminiscences of a Stock Operator, can be found in the description below this video. The principles derived from that hard-won experience form a complete and logical doctrine. The first and most crucial part of that doctrine is the ability to correctly diagnose the character of the market. The speculator must, before all else, determine if the market is in a clear trend or if it is merely drifting in a channel of indecision. A sideways market has a distinct and recognizable character. The price action of the leading stocks and the general averages becomes confined to a narrow, well-defined range. A rally toward the top of the range is met with selling pressure, and a decline toward the bottom is met with buying support. There is no sustained follow-through in either direction. The volume of trading during such a period is often, though not always, dull and lifeless. There are no great, explosive bursts of activity that signal aggressive accumulation or distribution by large players. The market feels tired, hesitant, and devoid of any strong conviction. It is, in effect, waiting for new information or a new catalyst to set its course. The line of least resistance, the great principle that guides all speculative campaigns, is not established. It is not pointing clearly up, nor is it pointing clearly down. It is pointing sideways. And to a professional speculator, a sideways line is a clear and unambiguous signal to stand aside. This is a market that offers no real opportunity for the trend-following speculator. There is no major swing to be captured. There is only a series of small, meaningless, and highly unpredictable fluctuations, the wiggles, as Livermore called them. And to trade on these wiggles is a fool's errand. The psychology of the amateur in such a market is a study in self-destruction. He is consumed by impatience. He sees the small, daily movements and believes he can profit from them. He mistakes the market's random noise for a series of signals. He will buy a stock as it rallies toward the top of its range, believing a great breakout is imminent. When it fails and falls back, he sells out with a small loss. Then, as the stock drifts toward the bottom of its range, he may try to short it, believing a breakdown is at hand. When it finds support and rallies, he is forced to cover, taking another frustrating loss. He is being whipsawed. He is being chopped to pieces by 1,000 small cuts, not just in the form of losses, but in the slow, steady bleed of commissions. His actions are not based on any clear evidence from the tape, but on a desperate hope that this next wiggle will be the beginning of a real move. He is not speculating. He is gambling on the turn of a card. He is betting on red or black. He has abandoned the science of reading the tape and has descended into the realm of pure, unadulterated guesswork. This is the fatal consequence of impatience. Livermore, having learned this lesson through the painful process of losing his own capital in his early years, developed a prime directive from which he would not deviate: the absolute preservation of capital during unfavorable market conditions. He came to understand that a speculator's money is his inventory, his ammunition, his very means of staying in the business. To risk this precious capital in a market that offers no clear, high-probability opportunity was, to him, the height of professional irresponsibility. He viewed his capital as a general views his army. He would not commit his forces to a confused, indecisive battle on unfavorable terrain where the objective was unclear. He would hold his army in reserve, keeping it rested, strong, and ready to be deployed with overwhelming force when the decisive moment finally arrived. Trading in a sideways market is a direct violation of this directive. It is the act of sending one's soldiers into a pointless and bloody skirmish, guaranteeing casualties with no hope of a strategic victory. The master speculator knows that the time to fight is not all the time. This led Livermore to embrace a position that the amateur trader fears above all others: the cash position. The amateur believes that to be in cash is to be missing out. The professional understands that to be in cash is often the most strategic and the most profitable position of all. The speculator who is in cash during a sideways market possesses two invaluable assets. The first is a clear and objective mind. He is not emotionally entangled in any position. He is not suffering from the psychological strain of being constantly whipsawed. He can observe the market's action with the cool detachment of a scientist. The trader who is caught in the chop, on the other hand, loses his perspective. His judgment becomes clouded by a string of small losses. He develops a desperate need to get even with the market, which leads to even more reckless and emotional trading. His mind is in a fog. The man in cash sees with perfect clarity. The second great asset of the man in cash is that his capital is 100% intact, his powder dry. He is ready to strike with his full force the moment a genuine opportunity presents itself. The trader who has been chopped up in the sideways action has not only depleted his mental energy, but has also depleted his financial reserves. When the real move finally comes, He may be too broke or too scared to act. So what, precisely, did Livermore do during these long periods of waiting? He was not idle. He was not on vacation. He was engaged in the most intense and focused part of his work. He was performing the art of patient observation. He would be at his desk every day, watching the tape with the concentration of a hawk. He was not looking for a trade. He was looking for evidence. He was studying the behavior of the market as a whole, and the character of the leading industrial groups. He was watching for the first, subtle signs that the character of the market was changing. He was looking for signs of accumulation in certain stocks or groups, the quiet, persistent buying by the smart money. He was watching for signs of distribution in others. He would be forming his market hypothesis, his bias about the market's next likely move. He might conclude that the next major move would be a bullish one, and that the steel stocks would be the leaders. But he would not act on this opinion. An opinion, by itself, is worthless. He was waiting for the market itself to confirm his opinion. He was waiting for the tape to give the final, authoritative signal. This is the difference between anticipating and confirming. The amateur anticipates. The professional waits for confirmation. That signal, the one that announced the end of the sideways market and the beginning of a new, powerful trend, was the breakout from the established trading range. This was the moment when the long period of indecision was finally resolved. But the character of that breakout was everything. A stock, or the market averages, had to move out of the range with power and authority. The move had to be decisive and sustained. And, most critically, it had to be accompanied by a sudden, dramatic increase in the volume of trading. This high-volume breakout was the evidence that the stalemate was over. It was the signal that the large, institutional players had finished their period of accumulation and were now ready to mark prices up. It was the clear announcement that the line of least resistance had finally turned from sideways to upward. This was the moment Livermore had been waiting for. This was the fat pitch. This was the clear, high-probability opportunity for which he had so patiently preserved his capital and his mental clarity. Only then would he begin to execute his first entry. A critical mistake of the impatient trader is to try and anticipate this breakout. After watching a stock move between 40 and 50 for weeks, he becomes tired of waiting. He will try to be clever and buy it at 41, hoping to catch the very beginning of the move. He is guessing. Livermore had no interest in guessing. He was perfectly content to wait for the stock to trade at 51, a point above the old resistance, before he would make his first move. He was willing to pay a higher price in exchange for a much higher degree of certainty. He was not interested in buying cheaply. He was interested in buying correctly. And the correct time to buy is at the moment of least risk, which is not at the bottom of a trading range, but at the moment the stock proves its own strength by decisively breaking out of that range. This requires a form of mental discipline that is almost superhuman. The human mind is an action-oriented machine. It craves activity and resolution. The desire to do something is a powerful and persistent impulse, especially when money is on the line. Livermore, like all traders, felt this itch for action. But he had learned, through the harsh discipline of devastating losses, to conquer it. He had trained himself to find satisfaction not in the act of trading, but in the act of correct and patient speculation. He learned that the money he lost by trying to force a profit in an unclear, sideways market was the most foolish and unnecessary money to lose. He learned that his greatest profits always came from the great, clear, powerful trends, and that these trends were relatively rare. This discipline is not a personality trait one is born with. It is a skill that is learned, a mental muscle that is built through conscious practice and a profound understanding of how the market truly works. It is the mark of a true professional. The ultimate lesson from Livermore's avoidance of sideways action is this: a speculator is not paid for his time, nor is he paid for his effort. He is paid for his correct judgment, and a massive part of that judgment is knowing when the market offers no clear opinion. To trade in such a market is to engage in a 50-50 proposition, and after commissions, it is a losing game. The professional waits until the probabilities are stacked heavily in his favor. This only occurs when a clear trend is established. The ability to correctly identify a range-bound market and the discipline to do absolutely nothing until that condition changes is not a minor aspect of speculation. It is the very foundation of a long and profitable career. It is the stark difference between the frantic, hopeful gambler and the patient, scientific master of the game.